There wasn't too much to talk about the S&P 500 yesterday. The majority of stocks down 1 to 2%, although we do see some big names, Amazon and Tesla, going on a bit of a run up 4 to 5%. Today, though, we are focusing on Micron Technology that did report their earnings after the market closed yesterday, and this was a very interesting company that does have some ramifications for Nvidia as well. Now, we will talk about their earnings, which they did in fact produce a double beat, and as we can see, in the pre-market now, it is down around 5.5%. This company was in fact down nearly 8% as well. Today we're going to do a deep dive of a company that we still have Wall Street indicating a strong buy for the portfolio. We're also going to talk about this company that does pay a dividend, not just focus on their dividend safety, but also look at some of their underlying metrics like their free cash flows. We'll also talk about some insider selling that we have seen grow quarter on quarter. We'll also talk about the institutions who again do seem to quite like this semiconductor company. And we'll talk about their latest financial results. They did release their investor presentation just yesterday as well. And including in our deep dive, as always, top line revenue, bottom line net income analysis, as well as the health of the company. Now today we are also going to do an in-depth look at the valuation model, getting to our intrinsic value and our acceptable buy price. Remember, we will incorporate our margin of safety and see if Wall Street still believe there is upside for this company that has been on a fantastic run. And we'll look at 3 different growth levels, low, medium and high, so you can also understand where our price projections are coming from and see what you yourself believe this company to be worth over the shorter term. Now, in terms of the earnings, the headline does read that their shares did slide. A reason for this, their revenue forecast failed to top estimates. Now, why this is interesting is because we can in fact see that despite better than expected quarter results from this chip maker, the shares did drop around 7%. Main reason for this, well, their guidance, which is very interesting. We are seeing a theme now with companies who are performing some excellent results on their quarterly basis, but essentially the analysts and the markets want them to increase their forward guidance. Do understand, very similar to other companies in the semiconductor industry, Micron has more than doubled just in the last year, as they do mention here, riding that artificial intelligence wave. So how well did they perform? Well, we can see on an EPS basis, 62 cents adjusted, 51 was what the market had expected. Revenue as well looking very nice, 6.81 billion, 6.67 expected. Now, that is quite an interesting theme as well because Nvidia have done exactly the same over the last 4 quarters. They have been beating on both EPS and revenue, and in fact, from time to time, they do increase their forward guidance. So there could be a question mark if Nvidia don't continue to increase their forward guidance. Will they suffer the same fate that we did see with Micron Technology? Now, one thing that I do want to point out, in fact, a few things here, is what the essential CEO has talked about. He has said that the company's AI-oriented products were likely to increase in price, and the company's data center, if you do remember with Nvidia, this was one of the areas that the company did grow massively, continues to grow 50% on a quarter-by-quarter basis. What he also talks about, which is very, very positive for this company, is that they essentially have sold out of their AI chips through to 2025. Now, another thing before we do move on, they also believe that this company will be one of the biggest beneficiaries in the semiconductor industry, essentially driven by AI. Now, I'm sure a lot of essential CEOs talk about this on their calls. They believe that AI will help drive their business forward. But again, we can clearly see, like Nvidia, like ASML, all these big companies, they do have a massive backlog, and Micron have in fact sold out, as they have said, their high width bandwidth memory that are using AI chips through to 2025. Now let's just talk about insider movement. Now, insider ownership itself does sit at 0.32%. 7 insiders have sold over the last 12 months, and for quite a significant amount, 102 million. Now, what we notice is over the last few quarters, the amount of insider selling has just been increasing. Quarter 2, so the latest point, 38 million worth of sales. Now, for those that are interested to see who it is, well, pretty interesting. It is the CEO himself who has sold in many different tranches. His largest one, literally just around 10 days ago, he sold over 34,000 shares, a price of $152 and around 5.2 million. Now, as always, you can decide whether or not you believe this is a bearish signal. What we always say is, that they do sell for many different reasons, personal reasons, financial reasons, but the information is there. Interesting though, for this company, it is the CEO who has sold in quite a few tranches just in 2024. In terms of the institutions themselves, well, more than 80% institutional ownership, 7.31 billion worth of outflows sales over the last 12 months, a little bit more buying by the same institutions over the same period. And what is interesting to note that is in the more recent quarter, there has been more buying, in fact, more than double buying, 3 billion over 1.2 billion sold. And the same is said pretty much for the last 3 quarters. So what we notice here, insider, or in fact, we should just say the CEO has been selling quite a number of shares in different tranches in 2024. Institutions, however, over the more recent quarter, as well as over the last 12 months, have been buying a lot more than selling. Important point here is though to always do your own due diligence, never copy movements of insiders or institutions. Now we move on to essentially looking at this company. What is it in terms of their revenues that the market does like? But before we do that, we just want to bring you up to speed with their historical performance. Year to date, they are up 67%, although it will reduce slightly given the fact it is down in the pre-market. Over the last year, more than doubled, 117%. Over the last 10 years, they are up, as we can see, 322%. And with this price drop, we will essentially note it will be heading more towards the midpoint of the 52-week range. Nonetheless, we do get a strong buy from Wall Street, a buy from Seeking Alpha with a hold from Quant, and we do see the forward yield fairly low, 0.32%, with a forward P that does look extremely high, although we will cover this and what we expect this to be over the next few years if they do meet those targets. Back to the revenue then, 16.4 billion. As always, 3 to 7% at a bare minimum. Do also remember that 1, the top line may be driven by AI, and 2, the cyclicality. What we actually note, there has been relatively minimal movement if you look just from 2024 to 2023. As we can see here, and from a graphical basis, very, very inconsistent. Something just to bear in mind. But as always, we will look to their forward guidance. In terms of the bottom line, is it as inconsistent? Well, what we in fact know, it has gone from 3 billion in net income down to around 5.8 billion in a net loss in 2023. And again, very inconsistent, not the first year where we have seen a net loss. So do factor these in into your essential valuation. And when we do come to that margin of safety, just to understand what is going on with this company, and we will also look at their forward guidance to see whether or not more of the same is anticipated. In terms of the health of the company, very important, 4.5 billion of cash and short-term investments in 2014. What we note in their latest quarterly report, pretty much doubled their cash position. Nice to note that is fairly healthy, although as always, just that number in singularity doesn't really conclude on anything, which is why we look numerically and directionally. What we then note for their total debt, it has also increased 6.6 billion in 2014, 14 billion in their latest quarterly report, and we can see the overall trend has been increasing over the longer term. So again, we will factor this in. It will form part essentially of that dividend safety that we will come on to shortly. So in terms of their earnings estimations, what does it look like? We always like to see in terms of track record. And what we do notice here, over the last 4 quarters, they have beaten analyst targets. So that is a 100% track record. Why we look at this? Because it gives us faith when we do look out, for example, to August 2025's EPS estimate. You can say with some confidence you believe they will hit that. Now, if they do, 9.05, a massive increase from August 2024, the forward P will drop dramatically down to 15.73. And we can see when we do look out to quarter 2 and quarter 3 of 2025, they're anticipating some very, very large increases, triple digit, to that earnings per share. As always, though, do factor this in. We will consider this in the margin of safety. The next thing we want to look at is essentially the underlying metrics and the gradings. First one we have here is the valuation grade, which they do get an F. Now, why is that? Well, we can clearly see their P on a non-GAAP basis much, much higher than the sector median. Although, as we did mention, if they do hit those targets over the next few years, it will lower dramatically. But right now, you are paying a 477% premium. As always, though, also bear in mind it could be justified, it could be warranted when we do come to look at the other metrics, but we will find our answer in today's episode. In terms of the valuation as a whole, what we are seeing here, C's and D's, showing us that this company is effectively trading at a premium to the sector median. In terms of their growth grade, well, they do get an A, but when we do a deeper dive, what we see here is their top line is down 21% year on year, sector median around 3.2. Revenue forward looking 6.3, again as we can see pretty much in line with the sector median. And one thing that we do take notice of here is their earnings per share 3 to 5 years is expected to decline by 4%, whereas the sector median around 14%. So quite interesting, but again, we will need to understand this, more importantly looking at forward guidance from their investor presentation yesterday. Profitability, well, a C-. Gross profit will be negative, as we did see there, in fact, that they had reported a net loss. Sector median around 50%. Bottom line, negative 21%, sector median 2.75. But as always, we will take a look at their latest presentation, and we can see cash from operations just under 3 billion, whilst the sector median 94 million. So overall, this part of the analysis did leave some questions we need answered. A buy rating from Seeking Alpha, a strong buy from Wall Street, a hold from Quant, F on valuation, A on growth, and a C- on profitability. Now, how exactly have they performed against others in the industry? So semiconductors in a similar size as well. We have Texas Instruments, Intel Corporation, and a few well-known others. What we do notice, this includes dividends reinvested. MU over the last 12 months is in fact the best performing by quite some distance, up 119%. Over the last 5 years, again, still the same story to be told, up 291%, the best performing. Over the last 10 years, however, they are pretty much in the middle point of their competitors. Still very strong, up 330%. But as always, past performance is not an indicator of how they'll perform in the future. And the main question you need to ask yourself, as always, do you believe it will outperform the S&P? If not, don't even bother considering this for the portfolio. So over the last year, let's look at historical data, even though we shouldn't use this as a basis for future. They outperformed the S&P over the last 12 months. Over the last 5 years, again, they outperformed significantly. And when we do expand it over the last 10 years, we can see 330%, the S&P 174. So that is a question you do need to consider with any company you want to invest in. So before we do jump into the dividend safety and the supporting metrics, let's talk about their financial result investor presentation. And what we do want to talk about firstly is one of the things they are very proud of. They've dedicated one entire slide to it. Their revenue at 6.8 billion. As we can see, that is up 17% quarter on quarter, which is always great to see double-digit increase. Up year on year, 82%. That is very, very strong, especially if this is anticipated to continue into the short term at a minimum. In terms of how they performed on a revenue segmental basis, well, what we can see on a year-on-year change, every single segment, we have the computer networking, mobile, embedded, as well as storage, is up very, very strongly. In fact, their storage is up triple-digit, 116%. When we take a look to the quarter, what we actually notice is, whilst we notice there has been an increase to every single one bar the mobile, we do have to understand that this increase year on year has started to slow down. So is this a sign of things to come? Will their top line revenues, will their profitabilities, and all these other metrics slow down, as that is an important factor when we come to understand what is the true value of this company. But we do know overall, other than the mobile, which has had a very minimal drop, the company is still growing. We then take a look at cash flow and capital allocation. One of the most important things that I do like to look at a company, how do they allocate their capital? Now from FY21 to FQ324, this is what I find interesting. They talk about essentially they returned a lot of cash to investor pockets through those share buybacks, through those dividends, as we can see, in fact, mentioning repurchasing 60 million shares. But what they then mention here is that buybacks are right now temporarily suspended. Maybe you wouldn't have picked that up just by looking at this. Something just to factor in. Again, it may not be important for a lot of people, but I do quite like to highlight these things. Adjusted free cash flows, again, we'll look at that in some detail, as that is an important metric that I also like to use into the model. Finally then, their guidance, which is very important because we want to understand, is this company increasing? And what we can in fact see is here, they are believing around 7.6 billion is what they will hit on that top line revenue. As we saw just a few slides ago, 6.8 billion was what they'd recorded in the previous quarter. So yes, they do see some growth coming in to the next quarter as well. But again, do bear this in mind when we do move forwards. Just to also let you know, we have released our latest free weekly article where we talk about 10 undervalued stocks. They have phenomenal balance sheets as well. If you want access to this or any other articles, all completely free, do click on that pinned comment below. You can start reading and get instant access to all of these straight away. So then let's move on to their dividend safety. Now they get a score of 60. It does look to be borderline safe. Market cap 158 billion. It is a mega cap company. Now, in terms of their dividend safety, it was reaffirmed earlier in the year that essentially their borderline safe means there is a moderate risk of a dividend cut over a full economic cycle. Well, how do they perform in the last recession? They didn't pay a dividend, so no comparative data, but they had negative 18% recession sales. Remember, the S&P was around negative 12. Dividend growth as well, they haven't increased that dividend since July 2022. Just bear that in mind if you are a dividend investor. They have increased though for the last 2 years and paying a dividend without a reduction. In terms of dividend yield theory then, do bear in mind it does show a company is undervalued when the current yield sits above the 5-year average. Right now though, we are seeing a sign of overvaluation, and in terms of the forward PE, well, it is much higher than the 5-year average and also higher than the information technology sector as well. Very briefly though, although as we said, their dividend isn't one that they really care about too much, it's not one they have a lot of focus on, but in terms of the free cash flow payout, below 50% is what we want to see for semiconductors. As always, free cash flow is what we focus on, as the earnings is susceptible to manipulation by management through accounting. And what we can see, it was negative in 2023. As we're about to see, they were free cash flow negative as well. Free cash flow per share then, what we do want to see here, increasing free cash flows over the longer term. What we actually note, this is one of those semiconductor companies that does show a lot of cyclicality, as we also saw on their top line revenue. Not something we see from others in the industry. Bear that in mind, just a quick heads up. 2023 for negative 5.6, although over the next 12 months, this is expected to increase to 3.58. Again, sales growth, no surprises here, as we did draw upon this when we looked at their top line revenue. Very inconsistent on a year-on-year basis, and we can see here clearly showing that trend that we did look at earlier. In terms of shares outstanding, do know share buybacks that we do love because it does return excess cash to our pockets. We do know over the longer term there is a share essential buyback net point, but what we also see is year on year very inconsistent, some years dilution, some years share buyback. We then move on to the ROIC, very important metric, above 12% for semiconductors, just to give us faith management are able to effectively allocate their capital. Very inconsistent again year on year, negative 9% on 23 due to the net loss. And when we do focus on those margins, again, we do get quite a large sense here of cyclicality, both on the operating as well as the free cash flow margin. Hopefully, though, moving forwards, based on the numbers that we are seeing, this can be something of the past, especially with AI, that they do believe will really help drive not just the industry as a whole, but their company as a whole as well. In terms of the net debt to EBITDA, below 1.5 is what we want to see. Remember, these numbers show us the number of years it would take the company to pay off all of their debt net of cash on hand. EBITDA, earnings before the interest, tax, depreciation, amortization. 2023 then, it is a little bit high at 2.05, probably why we do get to see that borderline safe score. Nice to note, over the next 12 months, they are anticipating to drop this down to 0.34, which is a great sign to show that balance sheet becoming stronger, as well as that dividend becoming stronger, which in turn may mean an increase to the dividend. So let's jump into the valuation model. As always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button, so you are continually notified of these videos as they drop. We then move on to the DCF model, which we believe to be the only one relevant today. Now, the average growth rate of that free cash flow has been very large over the last 10 years. Today, we are running through 3 different growth rates. First one we're going to start off with is 10%. Now, with the discount rate at 8%, this does give us the present value of future free cash flows and terminal value. We have used 2024's starting position as what management expect based on the data we just ran through. We add together with the cash, subtract total debt, get to the equity value, divide by those shares outstanding, and we get an intrinsic value of just over $100, showing overvaluation. Now, what this indicates essentially that if you believe over the next 10 years or beyond that their growth rate will be 10% to the free cash flows, right now that is implied downside of negative 24%. For those that believe that is way too low, then 15%, our medium rate, would indicate an intrinsic value of $138, not far off the market value in today, and we can see this would indicate upside of 4%. Again, people may be saying, the AI industry is going to grow much rapid over the foreseeable future. 20% is more accurate. Well, then, as we can see, the intrinsic value would arrive today at 42%. Now, these are all very subjective, and as always, you can click on the pinned comment below, grab a copy of this model, put your own numbers through. For example, if you believe that 20 again is too low, 25, and then it will change that intrinsic value. But in today's episode, we are going to stick with the medium rate of 15% towards the final slide. So this gives an intrinsic value based on the DCF model, based on the 15% growth rate of $138. Now, as always, the current price 133, with the market open, it may go a lot lower. In fact, it has started to rebound right away. So margin of safety at 10%. What we do now is we execute on that if we believe it meets our 3 golden criteria. A wide moat, strong financial metrics, good forward-looking data, and we can see it wouldn't be a buy until $125. For those who want a larger MOS level, around 118. Now do remember, all of these calculations are based essentially on a median rate of 15%. If you were to put different numbers in here, then this would also change. So right now, when we look at a 5% margin of safety, it isn't too far off, so that is pretty much what it is trading at right now. In terms of Wall Street and their forecast, well, as we saw at the beginning, they do still consider MU as a strong buy now. They have upside of 19%, their price target $158, and when we do take a look, they believe then that it is sitting somewhere between a 15 to 20% growth rate for the foreseeable future. As always though, let us know your thoughts in the comments below. Do you believe it is a buy? Are you happy with their earnings? Do you believe it will affect Nvidia moving forwards? And as always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button, and as always, we'll see you all on the next one.